Hey, welcome back to Quick Strike video number 15 for our February series of demonstration videos. Today we are going to look at part 2 of our historical volatility talk. So let's get started here. So as you see, we're on the product summary page. It's our landing place every time we log into Quick Strike for the first time. We're going to land on this page, Market Dashboard Product Overview. We spent time in our last video under Quick Volatility in the active expiration section. Just to reiterate, you're seeing 5 different sections available here in the box for the home page. In the professional version, all we're showing or making available is the active expirations menu. Active expirations, again, are expirations that are currently trading, still have DTE available. These other things are in reference to our larger historical database, which is referred to as quick volatility as the product itself. This other stuff is available as an upgrade, but the active expirations is available to all pro users. And we will get started now and cover the rest of this menu. As we mentioned in the last video, this is a legacy column here where we're not going to spend any time on this in the videos because we deprecated these pages, but then had some demand for people to be able to see that stuff again. So we put them back in there for some of our old users to keep them being able to look at the screens that they liked when we put this out there initially. So we're going to cover and finish up here with the volatility skew section. We covered historical implied and comparing expirations yesterday. Today we're going to look at vol curves, risk reversal and butterfly skew, and then comparing risk reversal and butterfly skew. So we'll jump right over to our volatility curves. Okay, and as you see, this is going to give you a view of what the smile vol skew curve looks like for a given expiration. In this case, we're on the April contract. We can go over here and take a look, and that we're on the March contract, right? So we switch over here underneath the expirations menu. You should be comfortable with that by now. We're looking right now at the settlement value. Since this is historical, we're looking at the settlement value for Friday, February 12th. Today's the 15th, it's President's Day at the CME Group, and there's no trading, so there won't be any history in there for today, but from a demonstration standpoint, this is covering Friday anyway. We're still basically in the trading day for Monday, so it should make sense to everybody who's watching. So what you're going to see when you land the first time, it's going to tell you your symbol, how many days to expiration, and where the future currently is. You have the current futures price here, that's a vertical line, and then you have the vol skew curve here. We'll also see the at the money volatility and how it's moved over a period of time, as well as the futures price, just to give you an idea so you can see what volatility's been doing, what the futures price has been doing. With the drop down, you can select and compare this chart to other charts. So in this case, we're going to see that on the 5th of February, we were much lower in the futures, and if you've been watching the metals, you've seen that we had quite a rally here in the last week or so. It might have come off today for what it looks like from the Globex prices that I'm seeing. But now we see that we have vol skew here for the present day or last trading day Friday, and the vol skew here for a week prior to that. So we have a pretty good idea that vol's up over this period of time. But one thing that we can't necessarily see here is because there's a discrepancy between the at the money's almost what is that, 43 plus 39, a pretty significant change, 82 in futures dollars that we have a move. So not always going to be able to compare apples to apples here in terms of at the money to at the money. So one thing that we've done for you in part of the chart section is we allow you to look at these vol curves from a buy delta standpoint. So what we've done here is we've created theoretical deltas using the listed strikes, and what you're able to do is plot the vol curves on top of each other, so you can really start to see how the at the monies relate to each other, as well as how the skew point or the smaller delta section of the curve relate to each other as well. So using vol by delta in the history lets you really compare and check skew against skew, at the money against at the money, as opposed to when it's by strike, you're going to see a shift, and you may not necessarily be able to do the same type of comparison. So, but again, both of them are very useful. Vol by delta gives you a little bit better idea when you're looking at at vol skew curves when the underlying has moved fairly significantly, or if you want to take a look and see what the skew has done uh, from out on the wing, so you get an easier way to compare how those are related to each other. Okay, so let's take a look at something a little bit closer. Let's look at Friday to Thursday, and we see, we still have even a jump here in volatility. Let's go Friday to Wednesday. We're probably going to see a little bit of jump as well. So, but you can see how you have the ability to see how much these uh, uh, ends of the curve have sloped up, so we can see if there's a significant change in the skew or the out of the money volatility values. Okay, so by strike, by delta, there's also a by moneyness, which is another way to sort of look at something from in a different scaling. So we're normalize this to like the 100% of at the money. So it's going to look and center you in a different way. It gives you a kind of a similar comparison that the vol by delta is. Just some people like to look at it from a money standpoint because they talk in those terms, and some people like to look at it in a delta standpoint. And then for people that are new to the trading of commodities, then the vol by strike tends to give them at least an idea of an easier way to sort of relate to what the spectrum of strikes looks like from a volatility standpoint. Okay, so that's active expirations, volatility curves. We also have under this section is a risk reversal and butterfly skew, and again we're going to be able to see historical ranges for these values as well. So what does this mean? So let's just go out here and pick, let's go to 25 delta, okay? So what's this mean? So what we're calculating here is if you go back and look at the exam, if you think back to the delta-based vol skew curve that we had, we are taking those theoretical 25 delta call and 25 delta put and taking the difference, as you can see here, as call minus put, and then plotting that value. And what that lets you take a look at is to see whether the calls or the puts are more in demand from a volatility, higher volatility, and one or the other is going to say that one or the other is in higher demand from the marketplace, right? So we saw here back in March where they were pretty much equally in demand. So that means you had sort of an even smile on the volatility curve. Then we see that puts became a little bit more fashionable, and we can start to take a look and see what was happening in the future. So we did have a bit of a decline. So puts became a little bit more fashionable, right? So it's a nice to have the charts here together to take a look at them. Then it sort of leveled off here as the futures leveled off, and then we saw a little bit of a shift here when we, maybe got a little bit of a rally back here up toward where we were early in March. And then as the futures broke here, we see futures broke here, we have a little bit more demand for the puts. And then as we kind of were in a steady pace, we had sort of a little bit of a creeping up from the puts to the calls. And then in this big rally, we see how the calls were in a little bit more demand, or significantly more from where they were a while ago. So what you can do with this, and you can plot more than one. So if I want to look at the 5, 15, and 25 delta, so now I can see that there's a pretty similar reaction across the board with the more wing-like, or the smaller valued delta or strikes out there being a little bit more bid from a volatility standpoint, that type of thing. That tends to happen as well. The curve will get a little bit steeper on the outside, but this is a real nice way to just get an idea of what's happening in the market from a skew standpoint. And again, when I say skew, meaning where the call volatilities are versus where the put volatilities are. Are people thinking that there's more of a chance to go up, so they start to bid up those call side volatility strikes, or do they think it's more has a chance to go down, so those puts start to get bid? So again, this is a it's a helpful way to look, say, what's it look like historically, how has it reacted to different movements in the futures, how is it reacted, what is the at the money volatility done here from a range standpoint while these skews have been changing. And you could see a lot of times you get some steadiness happening here, not too much movement, but you still get changes in skews. So that means your curve is going to be tilting left or right, being more sloped on the upside or more sloped on the downside, depending on which whether the calls or puts are a little bit more fashionable. Okay, so you can again, as we've said, you can export this data as well. You can change the date range like we talked about, and again, this is going to limit you to how much history we have for this particular expiration here, and you can change what delta risk reversal is showing on this chart. You'll notice that there's another tab here, the butterfly tab, and what this is doing a different math equation. Obviously, it's the butterfly math equation. It's taking the two in this case where we have three charts here. So it's taking, if we look at the 15 delta call volatility plus the 15 delta put volatility, and dividing that sum by 2 to give you an average of the two, and then subtracting the at the money volatility. So what this is saying is it's basically giving you the ability to look at saying, hey, are the wings more in demand than the at the money? So it's telling you how much curvature we have in that vol skew smile. So again, another way to see, if the out of monies are bid in relationship to the at the monies. And what's interesting here is if you look at this 25 delta one, you'll see that there is some bid in the 25 delta portion of that curve, but not quite that much away from the at the money. And it gets a little bit um, more there's more of an increase in volatility for the lower delta option as we move out from less small to more small, and that kind of makes sense because you're going to be steeper as you move out there, generally speaking. So again, risk reversal lets you sort of look at richness or cheapness of the call or the put in comparison to each other, and butterfly lets you compare the wings to the body or the at the money or the strike closest to the future in order to get an idea of where those volatility levels are. Okay, and then finally, we have a compare risk reversal in butterfly, and here's what you can do is, in this case, you can compare months of skew against each other, right? So here I chose April, May, and June, and I could plot an individual delta or risk reversal, okay, versus versus different months. Okay, so you can see if they're tracking each other or if they're diverging at all. So gives you a nice way to compare expirations. And again, we saw our text with our icons, so we can make a selection. So and as we remind you, the tabs that have expirations selected are going to show a little asterisk there, and I can go and choose from the current month, year ahead, and 2 years ahead. And we typically, I think we're running like three-year window on the gold expirations that are available for viewing. Okay, so we have our risk reversal version of this compare, and then we also have our butterfly version. So again, you can see how these expirations compare to each other, as well as look at the actual magnitudes of the individual ones here by yourself if you wanted to just plot them individually on a chart. Okay, so that'll conclude. Time flies really when you're doing these things, so we're already at a pretty significant time on this video, but that'll conclude our active expiration section. When we're done with the video series for February, we'll probably come back and do a more advanced quick volatility video that will cover some of these other pieces that are available in the quick volatility add-on. But for now, you should be able to watch these videos and be fairly comfortable with what information is being shown in the volatility charts and the volatility skew sections. As always, if you have any questions, please feel free to email us over at support, and we'll be glad to take a look and give you an answer as quickly as we can. So thanks again for watching these quick strike videos, and we look forward to your feedback, comments, or suggestions. So take care.